We all dream of it, right? That perfect trade entry. You see it online all the time, people pointing to the mean threshold of an order block like it's the spot.
Yeah, like it's the magic bullet.
Exactly. But is that really where you should be putting your money? Or is that maybe leading traders astray?
Well, welcome to the deep dive. Today, we're really going to cut through that noise. We're diving into order blocks, fair value gaps, optimal trade entry, and especially this whole mean threshold idea.
Okay.
Our mission really is to get clear on what the market's actually intending and, where those real high probability entries might be hiding.
Because getting this right, it's not just about fancy charting, is it? It's about, well, not losing money unnecessarily. It's about clarity.
Absolutely. You don't want to jump in too early and get stopped out right before the real move happens.
At all.
We've all been there. So yeah, let's unpack this.
Okay, so this mean threshold thing, I mean, you see charts everywhere with it marked up as the entry. People really seem to believe it's that hypothetical long entry.
It's a really common interpretation and honestly a fundamental misunderstanding. While, yeah, technically the mean threshold is the half point okay or median of a order block.
Right, the 50% level.
Exactly. But its main job isn't an entry point, not at all. Think of it more like a validation level. It's kind of a line in the sand.
A line in the sand. Okay, so it's more about checking if the order block is still, like, valid, still holding strong, not a buy here signal.
Precisely. You're using it to gauge the strength of the current idea. So for a bullish order block, you really want price to stay above that midpoint. Ideally, it should not be violated on the closing basis below its mean threshold.
On a closing basis, that's key.
Super key. A quick wick below might be okay, but a close below, that suggests the story is changing. And similarly, if you're looking at a bearish order block, let's say, within a bigger bullish picture, you don't like to see the middle of the down candle be violated if you think that bullish idea is still good.
Okay, so if price does breach that midpoint and importantly closes past it, that's like a warning siren going off.
Exactly. It's an alarm bell. It's telling you, hey, the original reason this order block was significant might not hold anymore. The underlying algorithmic intent may be changing.
Wow, okay. Understanding that alone could save someone a lot of grief. Just avoiding trades based on a level that's actually screaming danger.
That's the whole point. It's risk management. It's an early warning. Misinterpret that, and you could easily end up fighting the market, holding on to a losing position based on a busted premise. It protects your capital for the real setups.
Right, so this naturally leads to the big question. If the mean threshold isn't the entry, where are we supposed to look? What are the signals for those actual high probability trades?
Okay, yeah, good question. The real setups usually involve combining that order block with something else. And the absolute most critical piece, the thing that has to be there, is what we call a fair value gap or an imbalance.
An FVG or imbalance.
Yep. It's crucial. As the teaching goes, without the imbalance, there is no order block.
Without the imbalance, there is no order block. Okay, that's a strong statement. So just to be clear, the order block itself is what exactly, in simple terms?
Right, good point. An order block is essentially a specific candle or maybe a couple of candles where you can see evidence of large institutions placing orders. It's like a footprint left by smart money.
Okay, footprint. Got it.
So you find that footprint, the order block, but then you need the fair value gap. This FVG is basically an inefficiency in price. It happens when you get a really strong, fast move, one single candle pass up to the upside or downside, leaving a kind of void.
Like the market moved too fast?
Exactly. It leaves this gap, this inefficiency between the high and low of surrounding candles. And these gaps, they're like price magnets. They show strong order flow, and price is really likely to draw to them to fill that inefficiency or grab liquidity.
Okay. So the market often needs to pull back into that FEG, sort of rebalance things, before it continues its main direction.
You got it. It's like tidying up before the next sprint. And that's where potential entries lie.
So how do you actually trade that? Where do you put the order?
Typically, you look to place a limit order right near the edge of that gap. So for a short trade, maybe on the fair value gap's high. For a long, maybe just above candle number 3's high, referring to the specific candles forming the gap.
Okay, that's way more specific than just hitting the middle of the order block candle.
Much more specific, because you're targeting the actual area of imbalance the algorithm is likely interested in.
And then there's the other big one people talk about, optimal trade entry, or OTE. How does that fit into this?
Right, OTE. That's often called the gold standard of these kinds of patterns. It's a bit different. It's not about a single candle's midpoint or even just an FVG. It's about looking at a larger price swing, a significant move.
Okay, the bigger picture.
Yeah, and you're looking for price to retrace back into a specific zone within that swing, specifically between the 62% retracement as much as 79% retracement.
62 to 79% retracement of the larger move.
Exactly. And ideally, you're looking for that sweet spot, which is basically, the midpoint between 62 and 79. It's a Fibonacci-defined zone, not just a candle midpoint.
So a much more refined area within a larger market structure, that really highlights the need for context.
Context is everything. And while we use the Fib tool to find these OTE levels, it's important to remember the magic is not the Fib, it's the target of liquidity.
What does that mean, target of liquidity?
It means the Fib levels just help us identify zones where institutions are likely to step in, either placing new orders or taking profits off existing ones. That's the real liquidity target. The Fibs just frame it for us.
Okay, that makes a lot more sense. So given how specific these real entry methods are, FVGs, OTEs, why do you think so many traders get stuck on the mean threshold idea? It seems like such a basic mistake, but it's everywhere.
Well, I think it boils down to, human nature, mostly. We crave simplicity, right? Trading feels complex, so finding one single easy line on a chart feels like a shortcut.
The magic bullet again?
Exactly. People grab onto partial explanations, or they try to reduce these really complex ideas about institutional order flow into one simple rule, and they forget the deeper, layered understanding and context that's needed.
So they see price bounce near a mean threshold once or twice.
Right. Confirmation bias kicks in.
Yeah.
They remember the times it looked like an entry and forget all the times it blew right through. They don't see it as just a validation point, maybe a retest before price heads to the actual FVG or OTE zone.
Yeah, that makes total sense. We're wired to find patterns, even if they're the wrong ones. So practically speaking, how can listeners avoid falling into this trap? How do you train yourself to see the difference?
Okay, two key things here. First, you absolutely have to put in the screen time, but in a structured way. I mean, diligent backtesting and really meticulous journaling.
Just looking at old charts.
Not just looking. Actively engaging. Mark up those historical charts. Find the order blocks, identify the FEGs, see where the OTE zones were, note where price actually reacted, not where you wished it would react based on a simple rule. When you do this consistently, you start building what are called pseudo-memories. You're essentially tricking your brain into seeing something over and over again. As the mentorship teaches, the more you do it and you annotate your charts, the more experience you're going to have. You're teaching your brain.
So you're building this mental database of real price action, not just abstract rules. That makes sense. Almost like developing intuition through practice.
Exactly. It becomes second nature to spot the valid setups. The second crucial thing is context. Always, always align with your daily bias and the higher time frame picture.
The bigger trend.
Absolutely. You can't trade these patterns in a vacuum. If your overall analysis, your daily bias is, for example, bearish, then you simply shouldn't be looking for a bullish fair value gap to go long. That's fighting the current.
Right, that's just asking for trouble, like trying to swim upstream.
Precisely. You want to be working with the tide, moving with the EB and flow of these markets on a high time frame.
So how does the mean threshold fit into that higher time frame context?
It goes back to its role as a validation or invalidation point. If you have a bearish daily bias, for instance, and price violates the mean threshold of a bullish order block within that trend, that's an even stronger confirmation of your bearish view. Or if you were maybe tentatively long against the trend, which is usually lower probability anyway, seeing that mean threshold break tells you, okay, time to get out, cut your losses short. It reinforces your bias or warns you off a counter-trend idea.
Okay, that really ties it all together. It's about using all the pieces, the context, the order block, the FEG or OTE, and the mean threshold for validation, not just grabbing one piece and calling it an entry.
You've got it. It's a layered approach.
This has been super clarifying. I think understanding this shift from entry to validation for the mean threshold is huge. Should we do a quick recap, maybe a little drill for everyone listening?
Yeah, sounds good. Let's lock it in.
All right. Question 1, simple true or false. The mean threshold of an order block is your go-to primary trade entry location. True or false?
That's a definite false. It's that key validation level, the line in the sand, remember, not usually the entry itself.
Perfect. Validation risk management. Okay, question 2. For an order block set up to be considered really valid in terms of institutional flow, What critical price pattern or inefficiency absolutely must be present nearby?
That would be the fair value gap or an imbalance. Gotta have it.
Spot on. Like we heard, without the imbalance, there is no order block. Can't really ignore that.
Nope, it's fundamental. So, yeah, to wrap it all up, mean threshold, primarily a validation point. Helps you see if the order block story is still playing out.
Right. It tells you if the bullish or bearish idea is holding water, or if maybe the algorithmic intent is shifting.
Exactly. And those high probability entries, you're typically looking for them within that accompanying fair value gap or using the more refined optimal trade entry patterns, always within the context of the higher time frame bias.
And getting this right comes down to practice that diligent backtesting and journaling and always respecting that daily bias. Build that mental model.
Absolutely. So keep studying, keep putting in that focused screen time, keep testing, and always, always aim for those high probability setups that actually align with what the market seems to be doing. Discipline is key.
So thinking about everything we just unpacked, what's maybe the biggest aha moment or the key distinction from today's deep dive that might fundamentally change how you, the listener, approach your next trade setup? Something to really chew on.